Everybody talks about mutual funds, but what are they? What are their advantages and disadvantages? How do you invest in mutual funds? Let's look at that today. Very simply put, a mutual fund is a financial instrument in which money from several investors is pooled together. This money is then invested in financial securities such as stocks and bonds. What are the advantages of mutual funds? Mutual funds are managed by a group of experts who conduct extensive research and analysis in an effort to beat the returns of FD and savings accounts. Not just this, they also offer high liquidity, which means you can withdraw your money very easily at any time. Let's look at the disadvantages of mutual funds. Most mutual funds charge very high fees, and this reduces your returns. And not just this, there's a lot of difficulty in comparing between mutual funds. Most mutual funds are also inefficient when it comes to taxation, as a result of which we end up paying high capital gains taxes. Let's look at how to invest in mutual funds. There are two ways to invest in mutual funds. We can either go via the direct route, where we directly invest in the mutual fund house, or we can opt for the regular route, where we invest in the mutual fund through a broker. Knowledge is power. Let's look at the terms to know before investing in mutual funds. Expense ratio. This is the fees that is required to manage the fund. The lower the expense ratio, the better it is for you. AUM. AUM stands for Assets Under Management. The higher the AUM, the less likely the fund is to fail and higher the liquidity. NAV stands for Net Asset Value. Just as shares have stock price, mutual funds have NAV, which can track the performance